You keep asking for low caps, you keep asking for DJing players, you keep asking for high risk. So I'm going to bring you high risk, but it's going to be on the one condition. This is Vanar Chain. This is VANRY. Remember the number 695. We're going to talk about that very shortly. So you need to understand and you need to identify and you need to go through this process with each and every single one of your altcoins to understand at any given time how far down the risk curve that you are. Because basically, in simple terms, and this is just flipping your mindset, the higher the risk, the higher the chance of that thing failing. So if you've got a portfolio of $1,000 and you've got a risk curve of high risk altcoins as 75% of that pie chart, what does that do to you? That gives you a higher probability of losing everything. So you need to understand that the higher the risk, the lower the allocation. This is a simple tip that you can do on every single one of your altcoins. Go into CoinGecko, CoinMarketCap, whatever it is where you can get this kind of data. You look at it, this 695 that we were talking about, that is the rankings. What is the rankings? Now, imagine the list. You've got Bitcoin at the top, you've got Ethereum, you've got your blue chips like Solana, Cardano underneath. This is number 695 in that list, and the list is worked out by market cap. So this is 59,234,452. That is a small cap cryptocurrency, and it needs to be treated as a small cap cryptocurrency. That means that the higher the risk, the lower the allocation. So remember that, guys. I'm not going to tell you to allocate into this. I like it from a TA perspective, and that's what we're going to talk about next. So let's dive in. Let's get into the juicy stuff now. It's the TA that you're here for, guys. So you can see that VANRY is trading at 3 cents. So it's 3 cents at the moment. If we just look at the chart, as we've zoomed in on the daily, we've got one big barrier that we need to overcome here, which is the 200 daily moving average. That's currently set at 0.0364. Price action is not too far away from there. But what I want to talk about is this range here and this range here. So before we talk about this range, let's talk about the range that we're in. Are we bullish or are we bearish within the mean of this range? What we're going to do is we just stick it in here. This is what we're talking about. And then what we're going to do is pop in a fixed range volume profile. So let me just zoom that out a bit so it's a bit clearer. There we go. So a fixed range volume profile. This is before we bring in the indicators because we're looking for higher probability moves. Before we get high probability moves, we need to stack up the probabilities in our favor using the tools in our toolbox. So the first thing that we're going to use is a fixed range volume profile. And what I'm going to do is go all the way from here, all the way down here, and find out exactly whether it is the bulls or the bears that are winning within this range. And you can see here, the bulls are winning. So we've broke through, we've rejected from what? The 200 daily moving average. We've pulled back. Where have we pulled back to? This area here is the biggest area of traded volume within the whole of this range. And you can see that once we start breaking up, the volume gets less, the volume gets less. You've got one big volume spike here. Where is that? That is the previous lower high here. So you've got the one volume spike. That's going to be a resistance point at 0.0422 in the short term. Mark that out, 0.0442, coincides with the previous high. You've got your 200 daily moving average you need to overcome. So we're building a picture here. We know exactly what we need to do in the short term. So what we can do is we can just zoom into the 4 hour, and you can see, is the indicators or is price telling us anything within the shorter time frame? I'm going to stick in a trend line here. I'm going to see if we've had any kind of break. So it's trying to break, and guess what? It's being pulled back in trend. What is this, guys? We see it time and time again. You see it a 1, 2, 3 fake out, 1 touch, 2 touch, 3 touch fake out, back into trend. So we're coiling up, and you can see that there's a tug of war battle happening here between the bulls and the bears. This is where the fight is. What are they trying to do? They're trying to break, they're trying to close above. This is the 4 hour chart, the 4 hour 200 moving average, which is currently sat at 0.0332. So this is the shorter time frame we're looking into. So that's the area that we need to beat. You can see that we're just trying to break trend now. We can zoom back into the daily, and you can see this next level is the important level. Why is this the important level? Now, we talk about this, guys, time and time again. We say, well, I call it the pothole effect. God knows what it's called in real life, but that's what I call it. So you can see this area. Why is it an important area? Firstly, let's go back here. Let's go back in time. This is December 2023. And you can see that this area was a big rejection point, big rejection point, big rejection point, until what happened? We broke through what was previous resistance, needs to flip support. It regains that area as support. What happened here? Regained as support. So we can move on, and we can see exactly what happened next. This was our support base. This was our support base. So what's happening from a trading perspective here? People understand there's a high probability that this is going to hold, that this is going to hold, and then they put their stop losses there. What happens? What happens? Eventually, they get shaken out, and that's what I call a pothole effect. So it shakes them out. And why does it shake them out? Because these people here have got stop losses. What's happens when you've got a stop loss? That is a sell order. That means that they're wrong. They understand they're wrong. They're wrong with a limited amount of capital possible, and they're expecting further downside. So they get stopped out here rather than waiting for price to go all the way down here. So what that creates is an acceleration in price, down to the next support base. So we were down to the next support base. We held the next support base, and you can see this is where the battle that we were talking about in recent time is happening. So we're holding this strong support, and this strong support at 0.0287 is a good area to fall back on. It's a good area to fall back on. And you've got this low here. So understanding once you've got a break of trend, there's a high probability that that is the low. So what we'll do is we'll stick a Fibonacci on there as well. We'll see, is there any sticking points? Firstly, you've dropped the 61.8% retracement. That's one of the areas that we're trying to regain. So you can see that that's a rejection point. Once you drop through there, it's a rejection point, and that's double confluence because you've got this trend line here, then you've got the 61.8. So you've got the people, the bears, that are selling at the 61.8 once it had been rejected, expecting a further move to the downside. And then you've also got the people that are using the diagonal trend, expecting and move to the downside. So you've got double sell orders there. When you've got double sell orders, that's double confluence. When you've got double confluence, you've got a higher probability of rejecting. So playing the next move is as simple as, guys, waiting for a break of trend. Once you've got a break of trend, that helps you understand and identify that that is a high probability that that is the previous low. Wherever you're swinging for that high, you're swinging for this high. I'm not going to tell you what high to swing for. That's completely up to you. But understanding where you are as far as a risk management perspective is vital, guys. So that's an 8.82 risk to reward. Why is that area important? That was the area that has been respected, like we said, time and time again, as either resistance, or support. So we understand that that's going to be the next area of resistance. Once we break through there, then the barriers get smaller. How do we know that? We do exactly the same thing. We're going all the way back here from the top of the chart all the way to the bottom of the chart, and then we're going to see where the biggest area of traded volume is. Now, this is a higher time frame. Remember this. This is all the way here, 1st of December 2023. Look at where it is. It's pretty much exactly the same as the same area within this range. And what is price now? It is above it. So that's a high indication that price is not going to pull back through here. That's a high indication that we hold this high. The next thing that we do is look at the indicators, the stochastic RSI. Are we overbought? Are we oversold? We've come back down. We're oversold. That means that the bears have lost control and the bulls are trying to take their turn. So the bulls need to take back levels, and now it's their chance. You can monitor that. As that starts swinging up, you can see how high price gets. Where would that be a failure? If it done something like this, it's going up, and then it doesn't break, and it grinds, and that pulls to the upside. That would mean you're waiting for another swing to the downside and then a break. So it is a waiting game a lot of the time, but it is about giving yourself a higher probability move. So let's talk about how big these swings are actually. We didn't measure them. Let's talk about how big these swings are. So Fibonacci from this lower high here, there's two lower highs. There's the big one. There's a bigger one. We're going from this conservative one here. Why? Because we're not greedy. So you can see one thing. You've got the 38.2% retracement, 0.0844. Now, one good thing, guys, and I don't usually talk about the 236, but the 236 is a good indication to tell you once you get a break and a close, as far as the candlestick's concerned on the session, i.e. the daily in this instance, that once you get a break and a close, that shows that you usually get an acceleration back to the upside. So let's stick it on and see exactly where that is, because it's going to be good to follow this together. 236. So you got your 236. Right, okay, so look, clues look left, you can see the 236, that's been respected, got respected here, got a bounce here, got a bounce here. So you know the 236, that's going to be a strong area to break through in this instance. We don't usually use the 236, but when we're on a retracement and you get a break and a close, that shows an indication that you're going to get an acceleration. We understand that because we understood that the volume was getting less as we started progressing up and as we started progressing up, which indicates that the swings get higher as we start progressing up and as we start progressing up. So in the short term, guys, 0.0598, 6 cents, pretty much 6 cents, 236. That's going to be my next resistance point once we get a break of the 200 daily moving average, once we get a break of this trend, and then once we get a break of the 236, see acceleration all the way up to this 0.0843, and then the 618, 0.01240. So remember, guys, that's just a conservative swing. I'm going to get rid of the 0.5 because it's not a Fibonacci number. So if you look left, we can just do that and just pull this left. You can see why these Fibonacci numbers work. Look at how price respects between these zones. Comes, support, 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 falls through, where through? 236. Hits the 236, bounces up. Where does it fall back? 382 is support, pushes up. You can see how these levels are respected time and time again. So that's why we use Fibonacci, or that's why I use Fibonacci analysis. I call them magic numbers myself. But let me know in the comments what you want me to cover next. Did you actually learn something from this? Did you understand that when you go high risk, like something like this, that's 695 as far as the market cap's concerned, that means the lower the allocation. I'm not telling you to do anything, guys. I'm just showing you a process that you can follow yourself so you don't get wrecked. We are all about risk management. Remember, preservation of capital is key. You look after the risk, the reward will look after itself, and I'll see you in the next one.